In today's video, by Trading Techniques Toolbox, we will explore a new trading technique with two exponential moving average indicators, or EMA, indicators with a length of 10 and 30. First, we add the indicators for this strategy. We go to TradingView and click Add Indicators. Then we type EMA and add Exponential Moving Average twice by double-clicking on Moving Average Exponential. Under Technicals, we open settings of the first EMA. Under the tab style, we change its color to green. Next, under the tab inputs, we change its length to 10 and choose Smoothing Method EMA. For the other EMA, we change the length to 30, the same smoothing method, and its color to red. We will start by taking an example of a buying position. To make a good trade, it is important to keep 3 important steps in mind. Step 1. Enter the market. Look for crossovers of the red line and the green line. More specifically, the green line has to cross over the red line in an upper manner. As soon as this happens, we can enter the market and take a buy position. In this example, price already took a rather significant increase when we take our position. Step 2. Set up a good stop loss. Because price took a significant leap, it is safe to put our stop loss a little under the red line. We can always do this. That is, take our stop loss level on the red line, but in some cases, as we will soon see in the next example, there are other and better options. Step 3. Exit the market. We entered the market when the red and green line intersect with each other. To exit, we wait for the same thing happening, but the other way around. This means we wait for the green line to now cross the red line in a downwards manner. As soon as this is confirmed, we exit. In this example, we banked a nice profit of almost 25% in a period of over 2 weeks. I would like to note the most suitable time frame for implementing this signal strategy. Having conducted thorough backtesting for several weeks, we have concluded that the optimal time frame for this strategy is the 4-hour time frame. In the next example, we will study a sell position. The steps are the same as for a buy position, but in reverse. First, we wait for the green line to now cross the red line in a descending manner, and we can enter the market. As soon as we entered, we have to decide on a stop loss level. In this case, price did not move as far away from the red line as before. However, we can place our stop loss level above our last high. In our case, this is seen here. After we have set up our stop loss level, we wait patiently for the next crossover of the green and red line. As we can see, this happens almost but not quite on a certain moment. Whenever the crossover is not clear, we can decide to either wait and keep our position or exit the market. In this case, I opted to wait and got rewarded with more profit. Also, alternatively, to determine a good stop loss level above a past high, we can also look for multiple past highs and draw a box whenever price reaches these levels. This is called a resistance zone and gives us an idea on where to put our stop loss level more specifically. In our example, we can place it a little bit above this zone, as was already the case. Again, as we can see, we entered the market, placed our stop loss, and exited after waiting patiently for a clear crossover. Doing so made us again a nice profit in a little over 2 weeks.